Welcome back. I was just speaking with Beata Caranci. She, of course, is the chief economist at TD Bank. We were talking about their latest report. The only thing to fear is fear itself when talking about some of the concerns about the economy and talk about recession. We then shift the conversation to talk about headwinds facing Canada's economy, as well as some of the events that could derail the global economy. Here's that conversation. I want to talk a bit about Canada because I think there's lots. Canada has its own issues on top of that. But before we get there, event risk. I mean, we've got, what you've just laid out. We're not in a recession, but things have slowed down and there's some tentativeness around things. Then you have a White House shutdown, which we've heard is going to shave 0.1% GDP per week, if the GDP numbers even come out, because apparently those workers are not getting paid and won't be doing it. You've got the China trade wars, the China slowdown. You've got, the list goes on and on. Brexit. It's when you're older, getting a broken hip hurts you more than when you're 30 and getting a broken hip. So I wonder, how important are those event risks right now?
They're important. And so the way I've been describing the first quarter is basically think of it as your make or break quarter, because we already have market sentiment that has shown a degree of fragility to it in terms of financial market sentiment. We're seeing a little bit of transmission of that into the sentiment indicators. And now we're looking for stabilization of those indicators, not ongoing deterioration, but we have a lot of event risks and a lot of unknowns. And those event risks can throw you in one direction or the other with sentiment. So an example would be, if we have some great deal come out of the US and China on trade, this is going to be a market relief for certain, right, in terms of earnings growth potentials going forward. If that deteriorates and the U.S. follows through with the 25% tariff and $200 billion in goods, they already put 10% on, the threat is the 25%, well, that is definitely not priced into the markets, and then the markets will further deteriorate on that. So we're really at a nexus in terms of which direction we're going to go on this. And so the first quarter is pivotal. To your point, Brexit is another factor, less material for the U.S., but still material for global sentiment, where those PMI, those sentiment indicators are starting to sync up.
Let me ask you, I want to spend the last bit talking a bit about Canada, because if we talk about the event risks I just listed off, ironically, there weren't any germane specifically to Canada in those, but I feel as though Canada is in a tough situation right now where, we're seeing a bit of a slowdown. We've come through and we've secured a NAFTA 2.0, which is great. But, we are now having problems with China for political reasons. We've got auto manufacturers pulling out, like everywhere. I mean, that's, oil has bounced back, but still subject to global growth concerns, so down. I don't feel as though I can't say that's the engine of growth for Canada for this year. How are you feeling about it?
Yeah, so Canada's in an interesting point, because first of all, as a small economy, I always say we're a price taker. So whatever's happening in terms of down and upside risks, U.S. elsewhere, we just kind of absorb that. But to your point, we have some unique, what we call idiosyncratic features. And the energy sector is clearly one, and the adjustment in the housing sector is the other. So if we look over the last decade, since we've come out of the recession, what have been the two big drivers of the Canadian economy? At any point in time, it was either energy or housing. And both of those are in a quiet period right now in terms of, that's my nice way of saying it.
Beetlejuice way of saying it.
Definitely the production side is adjusting. That's helped with pushing up WCS prices, and that's a good thing. So it's being effective from that perspective. And the housing market is moving at best sideways. If we wanted to think of some positive aspects for the Canadian economy in terms of underlying fundamental drivers, because the energy sector, what we would say is right now is creating a lot of noise. That is a supply side adjustment. It's expected, even with Alberta's announcement that the production curtailments will ease as we get into the second quarter. We're going to get a pop in growth if that happens. So look through that as a temporary factor. The housing adjustment is certainly a more interesting one, because that's even when the Bank of Canada has cited that the housing market's weaker than they were expecting. So do we have more households sensitive to interest rate cycles, yes or no? Well, this is what we're going to find out. But what we do know is the fundamentals on the housing side still remain good. Examples would be we have the strongest population growth in the G7, and I don't just mean by a little bit, I mean double the growth rates you're seeing in many of the other economies. This is through immigration policy. Our immigration policy has been heavily slanted towards skilled immigrants. This creates housing demand, this creates product demand, and so typically your population is a good sign for where you're going in the future. And so that has been quite favorable. A lot of that population swing is coming in some of these provinces and cities that are having the slowdown in the housing side, so Toronto and Vancouver. Toronto has a very balanced, in some areas tight housing market. So we think we're still in the adjustment phase with the stress testing that came in early last year, some of the government policies, and now the higher interest rate cycle. But the Bank of Canada has moved to the sidelines. They've indicated as much. We don't think a rate hike is likely at the earliest until about July, and that's provided the data forms as they're expecting, so these rebounds on the energy sector and the housing market stabilizing. So we're not overly concerned on the Canadian side right now. We have low unemployment rates, very strong employment growth, decent wage gains happening, strong population growth. These are all net positives. We just got to see how the next 3 to 4 months form.